Welcome to Fund in Focus. I'm Sarah Allen and today I'm joined by Alyssa DeMarco from Magellan. We're going to discuss the Magellan Core Series. Alyssa, welcome.
Thanks, Sarah. It's great to be here.
To begin with, can you give us an overview of the Magellan Core Series?
Yeah, absolutely. So Magellan's Core Series, the origin really came back to what we thought was an important investor need, which was giving investors access to that active fundamental research that Magellan's known for, but at a more competitive price. So the Core Series really leverages the research strengths of Magellan, that is in global equities, ESG and infrastructure. And so these three funds, the way that they're designed is to be actively constructed, rules-based, and then competitively priced at 50 basis points. So on the rules-based and the active research, so when we're saying actively constructed, what we're meaning is that these funds leverage the research from our more than 20-person investment team that are doing the due diligence every day to identify what makes a quality company. So they're scoring each of the companies on quality, and then importantly, it has the oversight of our investment committee. Now then the rules-based part comes in. So we're taking those quality scores from our approved list of around 200 companies to invest in the top 80 to 90 by quality, whilst allowing for diversification. So we're upweighting the highest quality names within our universe, and then we rebalance the funds on a quarterly basis.
So you've emphasised quality there, and it's a critical component of the Core Series. Can you share Magellan's proprietary definition of quality with an example?
Yes, Sarah, it's a really good question because quality, I imagine you're hearing a lot within the industry, but the most important things about quality is it's the definition, firstly, but then it's the process to ensure that a company is meeting that definition, and then the process to ensure that that company remains quality into the future. So what's our definition? So when we're thinking about quality, we're looking for companies that are structurally advantaged, that have these what we call economic forces that will enable them to protect their existing earnings but also grow earnings into the future. So some of the attributes that we're looking for are like scale, switching costs, barriers to entry, network effects. Now, you might think, oh, they're all qualitative terms, and that's absolutely right. So we're really focused on that research, that qualitative thinking about what makes a quality company versus going into the quant side to determine our approved list. A great example is Netflix, a company that I think many of the audience are probably using. So it's the largest video streaming company in the world. Now, Netflix has scale. Now, whilst the switching costs are potentially lower, we can turn it off at any point in time. What really keeps us in their ecosystem month after month is that quality of content and what Netflix is known for with their back catalogue, but those new storylines, the new seasons that come out month to month. And that means they've got pricing power. So in the US, they've increased prices about 8% annually over the last 6 years. So as an investor, that's a really nice position where from your existing users, but then also your new users, you're able to generate this higher revenue. So just kind of stepping back, well, why is that then important? If you can identify companies that are more likely to be able to generate sustainable and attractive returns into the future, that they can reinvest in their business and then compound returns, that's a really exciting place to be. And what gets us excited about the Core Series is that we're leveraging this definition of quality. And the slide that's just popping up on the screen now, that is the performance of our approved list over the last 15 years. And it's outperformed the MSCI World Index by about 4 percentage points per year over that period. So we're investing in these great names that can continue to generate strong returns into the future.
You also offer an ESG-focused strategy. What criteria does a business need to meet to be considered for this strategy?
Yeah, it's a great question, and ESG is something that has been at the essence of our research process since the beginning. And importantly, we have got a recertification on the product rated at Sustainable Plus, which is really just that testament to the ESG credentials of the product. And so what are those? First, the objectives. So the core ESG fund fund, what it is focused on is to have lower ESG risk in the portfolio and also lower carbon factor risk. And to achieve those objectives, there are several different elements that we look at. So first is that ESG scoring, which is part of our overall quality framework, and then that is a direct integration into portfolio construction. Next is that we have exclusions for the portfolio. We have our low carbon proprietary framework, and then we have stewardship. So I might just touch briefly on each of those because it's quite nuanced and important in ESG and how to think about that. So on our scoring framework, we take a really practical approach. So all companies have ESG risks. And so when we're looking at an ESG risk, we're looking at that materiality to cash flows. So we look, okay, well, they're exposed to this risk. How do they manage the impact? And that's really the fundamental thought process when we're doing the scoring on ESG. And then those scores form part of that overall quality score that I mentioned. So that means that we're upweighting companies that have a lower ESG risk or a greater ESG opportunity in the portfolio. On the exclusions, similar to what you may have heard for other ESG funds, we have those revenue thresholds for the industries that are more detrimental to society, like alcohol and tobacco and weapons. But what's really unique about the core ESG fund is that low carbon framework that I mentioned. So what we're looking to do here is have a lower carbon factor risk in the portfolio than what you get in a broader benchmark. So we make a few commitments. One of those is to have less than a third of the world benchmark's carbon intensity. We look at the credibility of the carbon targets of the companies that we invest in. And then finally, we're looking at that link between quality and fossil fuels and whether or not a company's quality is linked to fossil fuels, and we would exclude those from the universe. So it's quite a detailed process, but really important and being true to label in how we think about managing ESG risks.
What level of crossover is there between the holdings in the Magellan Core Quality and the Magellan Core ESG strategies?
Yeah, that's a great observation. So there is a crossover. About 70% of the holdings are similar because both funds are based on that definition of quality. But it's those elements of ESG that I mentioned that then create that divergence in the portfolio holdings. So a few examples, I mentioned alcohol. So alcohol production is excluded by revenue threshold for core ESG. So the high quality names like Heineken and Diageo are included in the core global strategy. Then we have from the low carbon framework, the core global strategy will invest in the high quality names that would benefit from the energy transition, but they're higher emitting companies. So they're your waste management companies like Republic Services or Waste Management. And then the final element that we did was the scoring. So we have United Health, the largest health insurer in the US, that gets a higher ESG score because of the opportunity that it creates in improving access to healthcare in the US. So it's getting that ESG score, which then brings it into the universe and the portfolio for the core ESG fund. So a few differences between the portfolios, which is all about the rules and the portfolio construction.
Software is quite a significant component of the portfolio. Why are you finding more opportunities in this space?
Yeah, so when we do our due diligence, the software names often do feature, but it's not just any software name, it's that best-in-class software name. So the likes of your Microsoft, Adobe, Intuit, all meet that criteria that we are looking for. So when we think about a Microsoft, for example, so what are those economic forces, those attributes that we really like about them on the software side? So Microsoft Office is something, a product that pretty much the whole world is using it. It's got about 90% market share in that productivity software space. So it has that industry structure that we like. It has the intellectual property. It has scale. It has pricing power. So these are really important attributes that give us confidence that it can continue to generate that sustainable, attractive return into the future. And then that shift to cloud has just really accelerated the value that the digitization in the product that it's offering, that you now have that subscription revenue and that consistent revenue coming through month after month. So really, they can be really attractive businesses that play nicely into our definition.
So you mentioned digitisation there, and obviously that's been a trend that a lot of businesses have benefited from in the last decade. How important are structural growth trends like that to your definition of quality?
Structural growth is a really important element in how we're thinking about quality, but having one without the other to us isn't enough. We're looking for a quality company, and if it's a quality company with a structural tailwind, that makes all the difference. So just putting some bit of context on that. So when we're thinking about structural growth, there are many tailwinds out there like AI or the digitisation of payments, digital platforms. Now, we have a high conviction that these tailwinds will drive multiples of GDP growth over the next, let's call it 5+ years. But when you have such attractive growth, then you're going to have competition, you're going to have more investment. So if you can find a company that is high quality, that has those economic forces in a structural tailwind, then you're in a really unique position to be able to continue to get those attractive returns. Now, on the slide now, when you look at that, that's just a snapshot of the core global fund. And you can see several of those tailwinds that we are investing behind. So you've got your Visa and MasterCard coming through on the digitisation of payments, the digital platforms with Amazon and Shopify, and then AI with Alphabet and ASML. But importantly, the funds are diversified. So we still have the high quality names that are both cyclical and defensive.
What type of investors are these strategies most suitable for, and how can they incorporate them into their portfolios?
Yeah, so really just reflecting on what we've said, when we're thinking about quality, we're looking for those high quality businesses that can generate sustainable cash flows into the future. So using that to form the portfolio, this is a high quality, diversified portfolio that we think fits into any investor's portfolios when you're investing in global equities, because you've got that certainty of return through the cycle because of that lens of quality that we put on it. Now, it's not this get rich quick type of strategy. We're looking for companies that can sustainably generate returns that then can compound wealth for investors. The strategies are available as a listed and unlisted. So we're listed on CBO and available via major broker houses, but then we're also available via unlisted platforms and on our website, which is magellangroup.com.au.
Thank you so much for taking us through the Magellan Core series today, Alyssa.
Thanks, Sarah. It was great to be here.
If you've enjoyed this interview, please subscribe to Livewire Markets. Thank you for watching.